The world of debt is very nuanced. You can have debt priced at 5%, you can have debt priced at 35%. Why are some different? What makes it more expensive? What makes it less expensive? That's what we want to talk about today. So how is debt priced? Now, we're not going to dig into the specific financial performance of any particular company, but just from a high-level perspective, what are some of the variables that you can contemplate that are going to tell you, is this debt going to be more or less expensive? And so when we're working with companies to go out to the market, we understand the company, we understand what it does, but we also want to understand some of these variables, some within control and some less so, that are going to dictate the cost of capital from a debt perspective. So the first of these is going to be the risk-free rate of capital. And so you can think of that as, what is the treasury of a similar duration trading for today? And so if it was a 5-year treasury bond that was trading at effectively zero a few years ago, it's probably in the 5% range now. We'll have our trusted video editor add a screenshot here to say precisely what it is, but something in the 4 to 5% range. So okay, that risk-free rate, there's no way anyone's ever going to get capital at a price less than that if someone can just get that buying U.S. Treasury bonds, which is the lowest risk rate in the world, presumably. And that's a whole argument for a different day. But there's always going to be a premium over the risk-free. And so what is that spread? And so if you talk to banks, it may be one number. If you talk to non-banks, it may be another number. But it's at least the framework to think of the price of debt. Secondly, you want to look at structure. And so how do you want this capital? And so is it just a 5-year fully amortizing loan? Is it a 3-year fully amortizing loan? Is it a 2-year non-amortizing loan of just interest with a bullet at the end of it? And that starts to bleed into what are the objectives of the loan, because once you know why you need the capital, you can best tailor what that capital is, and what that tailored capital is going to dictate the price of it. So as you can imagine, the longer the duration, the less control that the lender has, the pricier the debt's going to be. If you said, I need capital, fully amortizing loan over 12 months, it's going to be a lot cheaper than I want an interest-only loan for 5 years, where the lender is carrying all of the risk throughout the duration of that. And that gets into the next topic of collateral. And so you'll hear cash flow loans, working capital loans, asset-based revolvers. There's all sorts of different types of structures of debt, but oftentimes what it boils down to is, what is the security? What is the collateral? And so if you're lending money to an operator of a fleet of bulldozers and the capital is loaned at 50% of the value of the liquidation value of the bulldozers, then you're pretty well collateralized, and therefore the cost of the debt should reflect that. Now, if you're similarly selling into a call center operator that the only assets are phones and all of the customers can go away the next day, that's going to be a more difficult thing to look at from a collateral perspective, and then digging more into the cash flows and into the fundamentals of the business. But generally speaking, the less collateral there is, or the lower the quality or the higher the quality, is going to dictate the price of debt. And lastly, it kind of builds off the idea of collateral, is the personal guarantee. So there's some types of debt that are not going to have a personal guarantee, or a PG as they say, and there's going to be some types of debt that do. Now, what is a personal guarantee? It effectively collateralizes the loan with your personal net worth and personal assets. So we've seen situations where people say, oh, I got a cash flow loan for the business, but it's personally guaranteed. Well, it's effectively PG'd against all of your personal assets, and therefore it is collateralized, just collateralized against stuff that's outside of the business. And so very important thing to keep a focus on. And look, there are certain situations where a personal guarantee is going to be unavoidable, and it's not always a bad situation, but in situations where there is an asset base that can be utilized to keep all of the risk in the context of the business and outside of kind of personal assets, and therefore as cash flow comes out of the business, it can be extracted in a way that cannot be clawed back, then that can be a valuable tool. And so generally speaking, how is debt priced? Well, 4 things we want to look at: the risk-free rate and premium over the risk-free rate, the structure of the debt, that gets into duration, use, etc., the collateral of the debt, and what is it collateralized by, and lastly, is there a personal guarantee? Lots of other variables to think about that play an important part in this exercise, but generally speaking, if you're looking at, is this going to be expensive debt or not, is it going to be cheaper debt or not, and I shouldn't say expensive or not if it's binary, it's more of a continuum like everything in this world. These are 4 things to consider. So hope the week continues to go well. Keep pushing forward. God bless. We'll see everyone next time.